All right, so I'm Ronnie Phillip with the Kingland Group, a real estate private equity firm based in Dallas, Texas, focused on Class A and B multifamily across the Sun Belt region. We've bought and sold 572 units, and we'll give a brief intro on Multifamily Masters. Multifamily Masters is a platform, a meetup platform, bunch of meetups across the country. So we do a Texas Multifamily Masters virtual meetup every month around the same time. We talk about different topics. We co-host it with our friends out in Houston, Ben and Ferris with Disrupt Equity. And I'll pass off to Anton for an intro.
Yeah, hi everyone. Thanks, Ronnie. Anton Madley, co-founder and CEO of Peak Financing, as well as one of the co-hosts of the Multifamily Masters Dallas chapter, together with Ronnie and John Montero, who is also on with us tonight. So we, as Ronnie said, we are hosting this virtual one once per month, together with our colleagues across the state, and we are ramping up our live events soon again here in Dallas. So please be on the lookout for that. In the meantime, hello, John. How is it going?
Good, Anton. Good evening, everyone. My name is John Montero. Again, co-hosting with Ronnie and Anton tonight. Looking forward to Yonah's presentation on cost segregation. It'll be a great session. I'm based here in Frisco, Texas, just north of Dallas. I am the founder of Texas Multifamily Investor Network. If you aren't part of the group, you can reach out to me and we'll get you in the community. But my focus is primarily multifamily in Texas, primary markets of Dallas, Fort Worth, San Antonio, and Houston, A and B class assets, as well as new development. So we also have some new development projects that we are currently working on and looking and sourcing some new potential opportunities. Just under 6,000 units under management with my co-GP partners and my investor partners as well. And just very bullish on multifamily here in the upcoming years. All the fundamentals are looking extremely strong from a supply and demand standpoint, especially here in Texas. And look forward to doing the breakout sessions at the end of the session and hopefully meeting with some of you.
All right, appreciate the intro, John. Still waiting for Yonah. I'm just trying to see when he's going to come on, but let's see. So yeah, we'll go from there. I guess in the meantime, we can just chat and see. John, you got anything new you're working on?
Yeah, we've had a very busy month so far. We've closed on 4 deals this month, sold 1 project today, just closed in San Antonio with my co-GP partners, and got a couple deals that we're hoping to get wrapped up before the end of the year. So it's been a strong 2021 for sure.
And be sure in the chat, guys, be sure to introduce yourselves if you are a GP and LP and where you are from. That way we know, and then we'll start to put together breakout rooms here soon. Let's see. I guess as far as cost seg, John, do you use cost seg on your deals?
Oh, every single time, absolutely. We actually use Madison SPECS on all of our deals. We actually engage them prior to us closing on a deal. So as soon as we have a letter of intent executed with a seller, as we are working towards our contract, our purchase sale agreement with our attorneys, we actually will engage our cost segregation experts to give us at least an estimate on what that cost segregation may look like, and the tax benefit associated with those efforts. So coming into our presentations with our investors, we actually have a pretty good idea in terms of what that potential tax benefit will be for ourselves and for our investors. So yes, we do it on every deal, and we engage them early.
Yeah, what about on new development?
Yeah, on new development, we do cost segregation as well. The rules around that is a little bit different. So we can actually begin our cost segregation efforts and be able to take advantage of those tax benefits as soon as certificate of occupancy is issued on the new building. So throughout the construction phase, we don't have the depreciation benefit, but as soon as we have the buildings built and we start moving into a lease up and we have that certificate of occupancy from the city, at that point we'll engage our cost segregation experts and be able to take advantage of the depreciation for that particular year.
Awesome. Well, we appreciate your insights, John, on not only new development, but on existing deals as well. So looks like Yonah's in the building.
I am in the building.
Thanks for hopping on, Yonah. So we're just chatting a little bit on cost seg while we're waiting, but we can go ahead and dive in right into the presentation on cost segregation. So if you could give a brief background on you, your company, and then what you do.
Sure, and I do just want to apologize. I sent a message about an hour ago to, I guess, the assistants or whatever, that I was going to be a little bit late. I apologize. I was stuck in traffic, just checked into a hotel over here. I'm in Denver. So time zones, I had to change my flight. Long story short, I am here. So glad to be here. My name is Yonah Weiss. I work for a company called Madison SPECS. I don't know what you guys were talking about beforehand, but I'm sure you mentioned John, Ronnie, you guys, Anton, have a lot of experience with cost segregation in general. So you could probably give the presentation too, but I appreciate you inviting me. Madison SPECS is one of the, if not the largest, national cost segregation companies. I've been working with them for a little over 4 years. Before that, I had a background in teaching. I was a teacher for about 15 years and got into real estate about 5 years ago, doing 6 years ago, actually, doing different things from fix and flips to doing some brokerage, commercial mortgages. I have a lot of kind of little bit of experience in a lot of different things and never really found where I could use my talents best until I really kind of stumbled upon this company and found it was just a good fit overall. So I'm very grateful to be a part of them. You may have heard of Madison. It's part of a bigger company, Madison Title. If you guys are familiar, in Texas, we have a big office there in Dallas. Madison 1031, we do a lot of things. So and Madison, just to give a background on Madison in general, been Madison SPECS, it's an acronym for SPECS, is Specialized Property Engineering Cost Segregation. So we're going to talk all about cost segregation tonight, and especially about how this is going to help. I think the topic here was passive investors, right? Because this is something that I get literally on at least a weekly basis, if not almost a daily basis at this point, people reaching out to me asking, how is this going to help, or how is this going to affect my passive investors? And people want to know, they want to understand this. And so, that's kind of part of what we're doing here. I also happen to, just in case you know, get a little more introduction for one more minute. I'm the host of the Weiss Advice podcast, which I'm very grateful to have had a lot of great guests, including I think some people here. We do a weekly meetup as well, which just ended. Actually, I had someone else take over for me because I was on a plane. And so we do that every Wednesday night. Welcome to come at 7 p.m. Eastern. So it wouldn't conflict with this. So if you guys want to check that out. And that's about it. I mean, what else do I have to say?
That's pretty much it. If you could share the links to your meetup and your podcast in the chat, that would be pretty helpful.
Okay, I will try to multitask and do that, as well as pull up the presentation that I did have here. Is that what you would like me to do? Do like a PowerPoint?
Yeah, go for it.
Yep.
Okay, great. Let's see which one we should use here. I think I have one. This one should work. Yeah, there we go. All righty, so let's just let's pull this up here. Let's share the screen. And before we get started, before I share the screen, I would love just to know, I see there's a lot of people here, recognize some people, some faces, some names, but a lot of you I don't. I would love to get an idea, if you wouldn't mind, give a just put in the chat. I see you guys are using the chat pretty liberally here. So now that everyone's names are in there, I'll put my thing in there too as we're multitasking. But I would love everyone to give me a background. What's your knowledge of cost segregation? Just want to know who it is, who we're talking to today. And I think the best way to go about doing that is if everyone would just put a number, the number 1 through 4. Okay, so I want you guys to write the number 1 if this is the first time you've ever even heard of cost segregation. You saw this presentation, or you come to the multifamily master meetup all the time, and you just, you're like, oh, this is great. So number 1, if this is the first time you ever heard. Number 2, if you've heard it before, but you really don't know what it is whatsoever. Obviously, you've heard cost segregation, you've heard these words, bonus depreciation, but really don't understand it. Number 3, Ronnie, we didn't give what a 3 was yet. 3 is, oh, David already knows from previous times. Number 3 is, if you already know what cost segregation, know very well, in fact, have used it yourself, okay? Because that's really where you really get a knowledge. You probably dive deep into it. You ask all the questions. You see it in practice. That's in number 3. So number 1, again, this is the first time you ever heard of it. Number 2, if you've heard of it, you heard the words, you really don't know what it means at all. Number 3, you know pretty well. And maybe on a great level. And number 4 is going to be maybe we'll get a couple of these. If you guys that should actually be giving the presentation because you know cost segregation, you're the real cost segregation expert, please stand up. I don't know, is Brian Bigham on the call here? Because Brian's our guy out in Dallas. You guys probably know Brian Bigham. So if he could certainly be giving this presentation as well locally in Dallas. But here I am in Denver, and we're giving this presentation. So let's just jump into it. I will share my screen. And it's great. I love to see that there's really a mix of a lot of different people. So I'm glad that a lot of you already have used cost seg and already understand that. Hopefully today we'll be able to answer all of your questions and hopefully get into a little more detail. So this is what I like to call the magical world of cost segregation. Is it magical? Simply because it does, right? Like magic to a lot of people. Okay, I know that there's reality to this, but I just don't get it. I don't understand it. So part of the reason why I call it the magical world of cost segregation is because these laws are in the tax code. We're going to talk about them, but they don't really make sense. Okay, we're taking advantage of them. But logically, you can kind of stretch it, you kind of figure it out. It's literally like like a godsend, the amount of tax benefits that we can get from this, as we will see tonight. Again, my name is Yonah Weiss. If we're not already connected on LinkedIn, I highly recommend you guys check me out there on LinkedIn. There you can find all my links. If I'm not able to multitask and put my links in the chat throughout this, but please follow up on LinkedIn. I'll mention it again at the end because that's the best way to keep in touch with me. So ignore this date because this was something I gave a while ago, I guess, and forgot to update this, but I can actually annotate that if you want. But what we're going to be talking about today is a cost segregation, all the understanding, all of the knowledge that you want to know about cost segregation, you're going to get tonight. I guarantee you. Okay. Any question that you may have, our job is to answer it. That's what we're here for. But we're going to talk about the basics. We're going to start off with the basics. What are the benefits? Who should be doing this? When you should be doing it? What's a real estate professional? We're going to talk about when you shouldn't be doing this. Okay, this is a very common question. We're going to do a case study. We'll talk about bonus depreciation as well, because everyone wants to know, what's this bonus depreciation thing? Is it the same thing? Believe me, I get this question asked every single day, literally. So I'm grateful to be here with you guys, some awesome people in this room today, and I'm humbled to be a part of this, but let's just jump right in. We'll do a case study. It actually may be a property you may be familiar with, maybe not, who knows? We'll see what it is. I forgot because I just pulled up this presentation from 2019. I had like 5 on my desktop and just clicked one random one. So this is what we're gonna do. Jump right in. Depreciation is a concept, okay? Do not be confused by the word. Depreciation means something's going down in value, but do not be confused that that's actually what this means when we're talking about real estate. It is a word, okay? It's the name of a tax deduction that's based on the concept that things go down in value as time goes on, and property does go down in value. Wait a second, your property is actually going up in value as time is going on usually, right? So we have to understand this. The IRS gave a name called depreciation, which allows you to take a tax deduction based on the purchase price of your property. You're literally allowed to write off the entire value minus the land. We'll get to it in a second. As a tax write-off, you bought a $10 million property. Guess what? Now you can literally take a tax deduction for not the whole 10, because again, some to land, but $8-9 million, but not all at once. Okay, that's all they say. You got to spread it out. Spread it out over 39 years if it's a commercial building, 27 and a half years if it's residential, including multifamily, because if people live there on a permanent basis, that's called residential. So you have to spread it out, meaning you take a little bit of a deduction every single year, and that's your depreciation. Now, I want to be clear here. It doesn't mean the things are, so don't be confused by the name. It's a negative thing. It sounds negative. It's really not. It's a positive thing. Okay, funny little story here, anecdote. I told it once before, so maybe if you want a previous webinar for me, you may have heard this. But how many of you guys are familiar with the site Bigger Pockets? Anyone knows what Bigger Pockets is? BP, Bigger Pockets. Yeah, you can raise your hand. You can say yes in the chat. Hashtag Bigger Pockets, something like that, BP. Okay, Bigger Pockets, big website, $1 million. In fact, tomorrow I'm going to be at the Bigger Pockets office at 6 p.m. Mountain Time. If anyone's in Denver and wants to stop by, we're doing a little meetup there. Shout out to everyone there at Bigger Pockets. They have a glossary on their website. Great glossary, great tool for newbie investors, for everyone who wants to learn everything about real estate. What's NOI? What's a long-term rental? What's leverage? What's LTV? Everything you want to know, anything, right? The glossary. In there, they had depreciation. So I clicked on it. What is depreciation? They published this about a year ago. What did it say? Depreciation, the opposite of appreciation. I was like, no, you know that hand on forehead emoji? Like, no, what are you talking about? No, it's not the opposite of appreciation, because in the context of real estate, it is the name of a tax deduction, which allows you to take these things. So I immediately messaged Mindy Jensen, who's the, runs a lot of stuff there in Bigger Pockets. And she was like, oh no, and fix it immediately to update it to the description that we're talking about today, because it is not. So don't hear the word and just think it means, oh, it's something that I'm going down about, But however, it's a long time to wait to take a deduction of your entire property value if you're not planning on holding the property for 39 years, 27 years, or you just want to be able to take advantage of the tax benefits. There's something called depreciation, and cost segregation allows you to accelerate certain components of the building that have a shorter depreciation life. Essentially, things that the IRS recognizes, things go down in value, have a much shorter useful life. Maybe you're going to have to replace the carpeting every 5 years. Maybe you're going to have to replace the appliances. So it has a shorter useful life. The IRS recognizes that. So in a sense, that's where real depreciation comes into play. However, it is somewhat arbitrary because your depreciation deduction starts the day you buy the property. Okay, and this is really important. It starts the day you buy a property based on what you paid for it. So, Ronnie, you guys may have bought a building, 5 years ago for $5 million, and now you're selling it for $15 million, right? So, but you get to take the tax deduction of $5 million, and the new buyer today gets to take it based on $15 million, and they start the whole 27 years from scratch, brand new. So it's not intrinsic to the property, including all of the stuff inside. So that's what we're going to do today and understand this a little bit better. So let's just take a simple example here. Let's say you buy a property for $1 million. You have to subtract a certain amount for land. As I mentioned, land does not, let's say 15%. Okay, pretty average. National average is going to be different places. I know Texas has different, every place has different laws, different percentages. What land is 50%, 850,000. That's your what's called your depreciable basis. That's the total amount that you can take as a tax write-off over the next 27 and a half or 39 years. How much does that play out to be? The first year is always prorated. So this is not exactly perfect because it starts the day that you bought the property. But if you just divide it up, you're going to be left with what's called straight line depreciation, which is what every accountant in the world knows. They know what depreciation is. And they do this thing called straight line depreciation. And it is 21,000, right? If you divide 850 by 39 years, 30,909, or close to 31,000 if you divide that 850,000 by 27 and a half years. So simply put, let's say this $1 million property brought in a net operating income, NOI, check the Bigger Pockets glossary, a net operating income of $60,000, let's say. Okay, pretty good, pretty low, but whatever, let's say $60,000 at the end of the day after all deductions, expenses. you immediately, depreciation says you immediately get to deduct $30,909 from that $60,000 income, and you're only taxed on the remainder. Okay, so you're only taxed on $29,000. Okay, that is what depreciation does. However, with cost segregation, we're going to be able to, as we're going to see shortly, front load these deductions, so you don't have to take just a little bit each year, equal amount, 2 to 3% of that property value. No, you can take a large chunk in the first 5 years or in the first year even, which is going to reduce your taxable income, hopefully to zero, right? If not, at least in the first year, the first several years, you will literally have zero tax liability from this depreciation, this cost segregation. We'll see the real numbers shortly how this works. So again, we are going to look at every individual building and engineer. It requires an engineer component to it, which engineer actually has to. What's this engineer, right? That comes in. Why is it specialized property engineering cost segregation? Because the IRS delineates, and we'll see later on at the end of the slides here, from the cost segregation audit techniques guide that describes what a quality cost segregation study is, right? In the tax code itself, it describes what you need, and it needs someone who's training in building, construction, engineering to be able to identify every individual component. So this word cost segregation, this name, 2 words, is a weird name, right? Everyone agrees, weird name. I don't know where the IRS came up with this, but it used to be called component depreciation. Okay, now that makes a lot more sense. Component depreciation. We're identifying every individual component, right? So if you look in this hotel room that I'm in over here, you see these lights, right? Fixtures, that's going to be 5-year property, right? The wall coverings, it's going to be depreciating on 5-year, right? The painting behind me over here, 5-year property. The carpeting, 5-year depreciation property. The engineer is going to come in and identify every individual thing that's non-structural and identify what's the value of those individual components, and segregate out the cost, the value, segregate that from the building structural components, that really the structure is the only thing that depreciates on that 27.5, 39-year schedule. We're going to accelerate those deductions, meaning you can take them at a faster rate. And essentially, that's what we're doing. Okay, so here is the list. This is from a multifamily property. It's actually from the directory. There are different types of assets in every different type of property that's out there. So this is not an exhaustive list, but this is just a sample of things that can be found in a multifamily property. Since this is the multifamily, right, masters, we are using multifamily property, but in a commercial property, and you can do cost segregation, by the way, on any type of property. It doesn't just have to be multifamily. It can be done on a single family, just not your personal residence. But you can do this on self-storage, retail, office, industrial, you name it. Any type of property, commercial or investment or business property, can have a cost segregation study done to it. And what do I mean by business property? Maybe I'll get to it a little bit later, but even if you don't consider yourself a real estate investor, but just own a business that owns a property and operates out of. But let's look at these asset classes. So essentially, like I mentioned a minute ago, we're going to be identifying all the components that are inside the property and outside the property that are non-structural. The structure, again, 27.5 years. Think about like the roof, windows, doors, walls, floor. That's all structural. Foundation, main electric, main plumbing. Those are all foundation. Those are all, structural components depreciate on a longer period of time. However, here we have things like building mounted floodlighting, okay? Cable TV systems, cabinetry, right? Cabinets, countertops, carpeting, equipment, furniture, appliances, all this stuff, even if it's rubber flooring or vinyl flooring, anything that's special purpose electric, like the light fixtures and things like that, all of that depreciates on a 5-year schedule, okay? Which means you can take the value of all these individual components as a tax deduction over the first 5 years of ownership. Land improvements, which is the second category here, is, and this is very common in large, garden style apartment buildings, like a lot of you guys acquire. You have anything that's not land. Remember, land does not depreciate, but land improvements, anything on top of the land does. So you have asphalt, concrete, right? Landscaping, signage, retaining walls, even playground or swimming pool, all that stuff, the concrete, all of that has value. And we're going to identify the value of all those individual components. And there's different, right? Asphalt and concrete paving versus concrete curbing. They have different values. Okay, what's the real value of those? How much does it cost to actually build those things? So we look at construction data, and we have software systems that help to compile these what these real values are, and then take that, again, land improvements over a 15-year schedule. And we'll talk about bonus depreciation in a second, but essentially remember this page here, because these 5-year and 15-year properties, all of these things, whatever amount that ends up being, can actually be taken all upfront in the first year with bonus depreciation, which we'll describe in more detail shortly. Any questions at this point until now? Feel free to put them in the chat. Does the quality, Thomas asks over here, does the quality of the component affect the time it takes to depreciate? From our countertop, absolutely, it certainly does, 100%. And so that's why, you know, engineers are trained to recognize what those things are and to be able to identify it. However, it's different, and this is something that even the most savvy real estate investors don't understand necessarily about cost segregation, which is that it's not the same as building new construction. So I know a lot of you guys, right, John, you guys are building ground up development. When you're doing ground up development, you know exactly how much is being paid. You have invoices, you know what's being paid for everything, okay? So it's very easy to allocate those costs to those families, to identify and break out those costs to a faster schedule. However, when you buy an existing property that has any countertops already, that were put in who knows how many years ago, has carpeting, has everything in it, what we're doing, what the engineers need to do is to take that purchase price and essentially reverse engineer the property as if every individual component that's in there adds up to that purchase price. Okay, so there's a lot of calculations that are involved as well. And so it's not so straightforward that, well, hey, I spent $5,000 on these countertops, I should be able to depreciate that. But no, if you bought this existing property and it had those countertops already in it, you may not be able to take the entire value. You may actually be able to take more, because if the property is bought for a lot more value, there's a premium added to every individual component to get us to add back up to that purchase price. So we're getting a little deep over here, but I think everyone is going to be understanding different things throughout this presentation in different ways. So moving right along, any other questions? Okay, let's just keep moving. So just to recap, I see there's some people that joined a little late, besides me, obviously, or some people that joined after me. What are we doing here? We are not creating deductions out of thin air. I want to be very clear here. What we're doing is accelerating that total depreciation amount. Instead of waiting and taking a little bit every year, you can front load a certain percentage, maybe 20, maybe 25, 30% of the total amount to front load that to the first year. That's going to reduce your tax liability and in turn increase your cash flow. Okay, because again, if many of you, I know I recognize a lot of you guys, so many of you, and I'm sure others that I don't know, will attest to the fact that you guys worked in corporate America at some point or another. Okay, is that a yes? Can I get a yes? If anyone worked in corporate America, just write yes in the chat. Okay, because if you worked in corporate America, you understand that your paycheck gets taxes deducted out of it immediately. And if you're self-employed, you have to withhold all these kind of things. However, with real estate, it's not exactly like that. Okay, with real estate, you make the money, you make that cash flow. At the end of the year, you have to figure out how much do I owe, right? How much money, all right, was made, and now how much am I going to be able to deduct? So that's the great thing here, is that you get to keep that cash flow. Okay, you get to keep the entire amount if you have more depreciation deductions than you actually have income. So Erwin asked a great question here: is there recapture, cost segregation, and bonus depreciation? Excellent question. I wanted to say that a little bit towards the end. We will get to depreciation recapture tax. Yes, it does exist, and it is not necessarily our friend, but it can be used, and there are ways to get around that. And someone wanted to ask a question? No? And someone has their mic on, maybe just unmuted. Okay, so here is an example, and again, this is an old presentation I gave a couple years ago, but essentially what we're doing, we're not front loading all of the depreciation of the first year, we're front loading a certain percentage, and that allows you, let's say you take this office building or multifamily, whatever it is, for 3.9 million, or for a multifamily would be, right, 2.75 million, But the same thing holds true in the first couple of years. You're going to have this huge spike, these extra deductions. And then even after year 5 or 6, where a lot of those deductions have already been taken, you're not going to be having zero tax deductions because you still have the remainder of the structural components being depreciated each year. Okay, so even towards the end, right, it's just relatively less. So it's even if you're planning on holding a property more than 5 or 6 years, it still can be extremely beneficial because again, you're getting the time value of money. You're getting to be able to use these deductions earlier on. So the Tax Cuts and Jobs Act a few years ago created this thing called bonus depreciation. If you guys know what this is, that's great. If you don't know what it is, essentially it allows you to, instead of, remember that slide I said, remember the slide, 5-year property, 15-year property, you actually have the option to take 100% of that in the first year. It used to be 50% before the Tax Cuts and Jobs Act, and that was only for new construction. But now, and there was a small window in 2017 that they still allowed that 50% to be used, even for new acquisition. However, it's 100% bonus depreciation. Anything that depreciates at a faster rate. So once you do a cost segregation study and you've identified what all that depreciable things are on a faster rate, you can take that entire amount. So if it's going to be 25%, you literally get to take 25% of your depreciation. So let's go back to our example over there of our $1 million property. In the first year, right, every year without conservation, you'd be getting about $30,000 deduction. Well, if you take 25% of that, in the first year, you're going to be getting over $200,000 because again, you subtract for land, but over $200,000 of deduction in that first year, which is incredible because what that does is that reduces your tax liability to zero, and it can also potentially spill over to other income as well, depending on what your status is, which we're going to get to shortly in terms of the real estate professional status, which is also one of the most common questions we get. So let's just jump right in here. Who should be doing this? Can anyone do this? Yes, anyone can do this as long as you're tax liable. And I do want to make clear that if you are a nonprofit, okay, and I actually have a client who told last week they received a certain endowment, an investor, one of their JVs or LPs was an endowment from a university institution that was a nonprofit, and they can't benefit from the community. They can take depreciation because it's a nonprofit. Okay, so it's something if you're looking to get these great investors from these endowment funds and things like that, just make sure that they are taxable because otherwise they won't be able to benefit from it. And that goes true with retirement accounts as well. It's something very common. People investing from retirement accounts. Not all retirement accounts are created equal, but 401ks, for example, which some people also call QRPs, which just stands for Qualified Retirement Plan. Those 401ks are, you cannot take depreciation because they're already tax sheltered. Roth IRAs are the same. So just be wary of this. If you're taking investors or you yourself want to invest from these vehicles, I highly recommend it. However, just be clear that you may not benefit from the conservation whatsoever. Now, is there anything to be done about that? One might ask. Well, how can I? What if 50% of my investors are coming from retirement accounts and the other 50% are not? So if we do a conservation study, some will benefit and others will not. But is there a way to allocate? And this is a question I get asked a lot. Is there a way to allocate depreciation differently to different investors? Good question. Yeah, anyone? No. Okay, it's a good question. There is, but I would check with your accountant, your attorney, because it needs to be set up in the operating agreement, and it may be have to be different classes of shares and things like that, where they may not be getting necessarily equity ownership, they may be getting proceeds and things like that. You would have to set it up differently, but it can be done. Okay, just to be clear, it's something definitely to look into, and it doesn't matter who's investing, if it's a corporation, if it's an LLC, as long as the partnership owns the property, each partner will get, or each investor will get, their percentage of depreciation based on their percentage of ownership. Okay, and that is that's something that everyone needs to know, because you ask, okay, if I'm going to invest X amount of dollars, let's say I put in $100,000 into Ronnie or John's next deal, well, how much depreciation am I going to get? Well, you need to make that calculation. What's your percentage of ownership? And that will determine the percentage of that bonus depreciation or that depreciation that's going to be allocated to you. And this is something that we do also. Brian has a model, Brian Bingham model, where he does this kind of sends out, and so everyone can know according to their investment what they get. What types of properties? And I mentioned, obviously, you guys are multifamily investors, but there are many different types of properties that actually get different types of benefits. On average, the reallocation of costs, meaning from that total depreciation to these faster lives for apartments, multifamily on average is about 27% or so. There's certainly cases where it can be more, 30, 35%. But there are a lot of factors that need to come into play. There are, different types of properties. Auto dealerships, right? Hotels have a little bit more because there's a lot more furniture and fixtures, laboratories, mobile home parks. This is a huge one, literally off the charts, because mobile home parks are really essentially just land improvements. Okay, you own, especially if you don't own the homes themselves, and the homes themselves, if you do own park-owned homes, they can be 5-year property. Maybe they can be considered personal property, but the rest that you own is literally just land improvements, what's on top of the land, the concrete, the asphalt, landscaping, etc. All of that's 15-year property. You can literally get 60 to 80% of the purchase price going into the bonus depreciation from those categories. So mobile home parks, anyone interested in figuring out what's the maximum amount of depreciation I can get, maybe while looking into mobile home parks. So let's get into this real estate professional status. A very common question we get. And like I said, this is going to determine how much depreciation you can actually use, what you can benefit from. And I think there is a misnomer. A lot of people think that you can use depreciation against your W-2 income. Unfortunately, that's not true in most cases, because passive income, which real estate rental property income is considered passive income, that's in one bucket, okay, on Schedule E on your tax return. And the IRS treats that separately than they do any other type of earned income. Okay, so passive income, even though it may not be necessarily passive, right? It might be, especially for, for totally passive investors. Nevertheless, it's considered, rental property income is considered passive. And depreciation, which is a passive deduction, can only be used to offset your passive deductions, okay? However, and so if you have more depreciation, let's say in that case, you had $30,000, $60,000 income, but $200,000 tax deduction, what happens to, okay, $60,000, pay zero tax, what happens to the extra $140,000? Where does that go? So it creates what's called a passive loss. That passive loss is basically like a negative bank account on your tax return. And if you are not a real estate professional, if you W-2, whatever it is, that passive loss just carries forward, meaning you can use it next year, but you can't use that in the current year against other income, okay? Unless you make less than $150,000 of adjusted gross income, then you can apply a certain amount up to $25,000. I'm not gonna get into that too much, but if you are a real estate professional, you literally do not have any limitations. You can use any of that extra deductions against your active income, whether that's from a W-2, from you or your spouse, obviously from one spouse, because you can't be a real estate professional and also have a W-2, or whether it's from other income. If you're a broker and you're making a lot of money, I highly recommend you making sure that you own real estate as well. You invest in real estate so you can take advantage of the depreciation deductions against your active income, right? You're making money as a broker, make sure that you get these depreciation deductions because you automatically qualify as a real estate professional. So let's define it. What is it? You or your spouse, only one of a couple needs to qualify for this, and then you can use that against both of your income. And if you have a W-2, you essentially cannot qualify as a real estate professional status. This is basically writing on your tax return, what is your profession? What's your occupation? Real estate professional. They'll see, oh, you have a W-2. You can't do that. Now, I do have a lot of clients that try to claim it, and they'll say, well, I have a lot of properties. I self-manage them, et cetera, et cetera. The IRS doesn't really care, unfortunately, even though in theory, it could be that way. You may actually spend more time on your rental property than you do in your W-2. However, they don't care. And every single time it's been challenged in tax court, it has been overturned when someone's tried to, every single time without an exception. So don't do that. But only one of you, one of your spouse, needs to spend the majority of your time in the real estate trade or business, and that minimum and materially participating. I want to stress that because that's the operative word here: materially participating, not just passively investing, but actually doing the following things in the second column here. But it needs to be a minimum of 750 hours. So 750 hours is not a lot of time. It's about it's about 16 hours a week if you break it up in the whole year. So it's not a lot of time, but you can't just be totally passive. You have to be involved. So what are these trades that define you in the IRS's eyes as a real estate professional? You're doing development or redevelopment, constructing, reconstructing, acquiring. That's the process of actually buying a property. Not necessarily looking at 100 properties, but actually the process of buying the one that you actually did buy. Converting it, that can include hours spent with municipalities and planning and things like that. Rent, leasing, operating, managing, brokering, any of these things, if you're involved in these activities, these are real estate professional activities, especially if you can show that you own property and that's where your main source of income is. It's pretty easy to also show that you are involved in these activities. Okay, so pretty straightforward, pretty clear. You are going to want to have some sort of log. At least that's what I've been advised by many accountants, because if you, especially if you just have like 1 or 2 properties, you're going to want to keep a log to actually track the hours you're spending and doing these activities so that you can, pass it if God forbid you were ever to be audited. So let's just jump right in here. One more thing before we get to the case study. When should you be doing this? Okay, a lot of people reach out to us before, right? Once you're under contract, like Ron, you guys know, I want to know what our investors are going to get. What are going to be the tax benefits if I do this? So as soon as you go under contract, you want to know that, right? So you reach out, we provide a free feasibility analysis so you can know ahead of time what the potential tax savings are. But it can be done immediately after acquisition. It can also be done on a renovation or an addition, because as I mentioned at the very beginning, when you buy a property, your depreciation amount is based solely on your purchase price. It doesn't change if you get an appraisal. It doesn't change if the property goes up in value. The only thing that's going to change is if you actually add more money, capital improvements back into the property. Okay, so what you're going to be doing with the capital improvements is you bought a property for $1 million, then spent $1 million renovating it. That extra $1 million is going to be added to your basis, and that amount you can now take as a tax deduction as well. Okay, and though whatever's spent on those capital improvements can be divided and congregated as well. So you get that out, you can get that through construction. Obviously, most important as a look back study, which is that you, even if you have owned a property for a number of years and you were doing what's called straight line depreciation, you never did consolidation, you can go back retroactively without having to amend your tax returns and get those tax deductions this year by doing consolidation retroactive. Okay, a look back study again does not require amending of a tax return. So let's move right along. I see we got a great question here from Matt, and I will get back to the question from I believe it was Erwin earlier on about the bonus depreciation. Ask, can the carried over, Matthew asked, can the carried over, which I just mentioned, the carried over depreciation be used to offset capital gains? For example, year 1, they have 50,000 pounds of income, but have 100,000 depreciation. Year 2, I still have capital gains. Can I use 50,000 in excess in capital gains tax? The answer is yes. Okay, because capital gains on, well, I do want to clarify that capital gains from state is considered passive gains. Capital gains from stock market is considered active gains and more treated like active income. So for passive gains, the answer is yes. For active gains, the answer is no, because depreciation as a passive loss can be offset. Passive gains, another passive gain would be a great segue to the what's the question? What is passive gains? Another passive gain is the recapture tax, right? When you sell a property, this is a great segue. A tax, or you're subject to a tax called recapture. It's rates based on the different types of property, right? The main structure and things like that are taxed on a 25% rate or capped at that amount, and other property with the cost segregation, bonus depreciation amounts are taxed on a ordinary income rate. However, there are methods that is a passive gain, which means if you sell a property and you in the same year have the recapture tax in the same year have a cost segregation from a different property, you can literally have those gains, those losses offset those gains and not even have to worry about the recapture tax that you were subject to. So what's the difference between straight line depreciation, cost segregation, and bonus depreciation? So in a thing I will mention, Erwin, because depreciation, oh, thank you, Hezi, also another CPA here, for that comment. I'll get to that in a second. straight line depreciation essentially is when you're taking that 27.5 year and you are taking it a little bit every year. However, from a tax perspective, there's actually something called a double declining balance or 150 declining balance as opposed to straight line. So I don't want to get into too technical, but simply put, what we call accelerated or straight line is when you're just taking a little bit each year, on a 27.5 year schedule. But when the segregation, you are front-loading, you're putting a 5-year property, the personal property, on a 5-year schedule. Okay, so $100,000 is now being depreciated over a 5-year period, taking $20,000 each year. Your 15-year property is now to be depreciating another $100,000 on a 15-year schedule. So you're taking a little bit each year. That's the difference between concentrated and bonus depreciation. Allows you to take that entire amount of accelerated depreciation in the first year. Okay, so that's the difference there. So we had a few more comments here. Let me get to those in a second. Let me see where our next slide is going into. This is going into our
Not sure what happened. Let's see.
you guys, hey, what happened there?
I don't know. You can continue though.
Okay, I will continue. Yeah. So I was just mentioning, and I lost the chat. So if you guys want to, because whenever you get bumped off, you lose the chat. But if anyone wants to read those messages that were there, Ronnie or someone else wants to read those, maybe let's wait till we finish this case study, and then we'll get to some of those questions, because a lot of great questions. Keep them coming. If I don't answer them now, because actually, but like 6 minutes, but we will get to me. Happy to answer any and all questions as we go for any time. Multifamily property is a 32 unit, 1.75 million, a little bit less. This is a couple years ago. So in Texas, you're probably not getting that good of a deal for a 32 unit, right? It's probably more like $5 million. But it was a multifamily property. He had many single family rentals. And I mentioned this having to do with the fact that he wanted to do a 1031 exchange and failed the 1031 exchange. Now, 1031 exchange allows you to
Yeah, I'm not sure.
Yeah, I think his connection is a little bit on the weak side.
I keep getting bumped off. I'm not sure if it's my
I think it's
your internet is a little bit on the weak side. That's probably why.
Yeah, it could be the Wi-Fi here is not so good.
It's pretty choppy, but go ahead and share your screen, Yonah, and go from there.
All right. Okay. So, anyways, here he did this great deal, but had actually a 1031 exchange that was failed. Okay, and that's important to note because he had a big capital gains tax because he wasn't able to complete the 1031 exchange. And as a result of the conservation study and the bonus depreciation, he was actually, similar to the question we had earlier on, he was able to not only offset his income, but also the capital gains tax that he would have had to pay. So that was a big win for him. Without conservation, the depreciation would have been $54,000 and change, because again, that's taking the 27.5 years, 1.75 million, dividing that by 27.5, subtracting land, and then taking a little bit each year, 54,000. However, his income, this property was about $120,000. So that wouldn't have been enough. He would have been taxed on, $75,000. We don't want to get that happening. So what do? Cost segregation. We allocated 15% for land, 70%, what that was going to building components, structural components, and then you see your 15-year, 5-year property, 28 totally. So the total amount of the accelerated depreciation was over $420,000. Okay, that's important because the $120,000 of income totally wiped out in that first year, and the capital gains that they'd have was a couple $100,000 was also completely wiped out in the same year. Now, I will note that it's not necessarily something that everyone wants to do, to use your depreciation deductions to offset your capital gains tax, simply because some accountants will say, hey, this is a bigger deduction and the capital gains a lower rate. Why are you higher deduction, higher potential deductions to offset think that taxes. Nevertheless, everyone has to account for the situation and understand what's for them the most, and consult with your CPA and understand that. So, questions. What should be looking for quality cost study? Like I said, to take from the off this time. I cannot. My husband stopped. Okay, that's okay. Probably because my connection. So, anyways, what we're looking to do, study, make sure you have a quality consideration, meaning done by an engineering firm, because they're using the audit techniques guide, meaning they're following all the rules, and you're not just trying to wing it, not coming with some very, tough or something like that of the depreciation sheet. You actually has all, show your work, right? You remember in school, right? You got to show your work. You can't just, put it in a calculator and come. So check this, and yeah, I guess that's pretty much it. That's okay. Right? Consult with your tax professional or legal professional. This is for purposes only. Anyways, you can reach out to me on LinkedIn. Please time for questions. So let's get that chat over there. Doesn't matter. Let's see what I have, because I did lose. Oh, I didn't lose. Okay, good. So who asked the question over here? Raz asked, how do you respond to a CPA who says depreciation is not worth taking because it will be captured when you sell the apartment? I think it's important to understand every individual's situation. When they say it's going to be recaptured, I think that's a misnomer. It's not recaptured. What it means is, because people think I take $100,000 depreciation, I have to give back $100,000. That's not what it means. Recapture tax is a tax that you're subject to. And as I mentioned before, there are strategies and methodologies that you can literally get around that recapture tax on the sale. So besides for the fact that you're beating inflation, number one, which is creep up on us a lot, and the time value of money, which means use your money today, reinvest that. I mean, a CPA probably should understand what's called, time value of money. That's finance 101. Okay. I mean, that's just simple. You compound interest, you reinvest that money you saved from paying taxes. Like, why would you not do that? However, if you are planning on selling very quickly, meaning like within a year or two, it may not be in your best interest to take the consideration, because you literally will have that recapture tax very soon. So it's something you're going to have to obviously weigh your situation. If you're a person who is just a one property person, okay, one property person, which means, if you only have one property and you're going to buy it, this year, sell it 5 years from now and buy another property at that point, it may not be your best interest. However, you're someone who is constantly buying and selling, buying properties, you want to be scaling. It literally is one of the best strategies out there, because it allows you to scale faster by not doing that. Okay, so let's just move right along. More questions. What other questions do we have here? For some reason, I'm not seeing the chat anymore. Where'd it go? Okay. Can't see the slide deck. Yeah, my connection got. Yonah, what do you mean accelerated depreciation, bonus depreciation? Right. Erwin, again, accelerated depreciation means any depreciation that is at a faster rate than the structural components. Okay, that's what we mean when we say accelerated depreciation. So it can mean both. Were there any other questions that I lost when I lost the chat?
Yeah, I'll go back and see if there's anyone. But in the meantime, just answer the other ones.
Yeah, I think I got to all the ones that I can see. Sorry, Mike. No, who had one more? Mayor had a question. Does it matter what point in the year property is acquired? For example, if I close property in December 2021, am I only getting a month depreciation write-offs? Yes and no. Yes, in the fact that depreciation is prorated, which means you will only be getting a month of depreciation write-offs. However, no, because you are eligible for bonus depreciation, and you're literally allowed to take 100% of that depreciation. Even if you close on the property December 31st, you can take it in 2021. You can take that bonus depreciation. So those are all the questions that I have. And conservation is just something that only needs to be done once on a property, and you set up your depreciation schedule for the length of ownership.
All right,
That's
well,
all
I
got.
guess
If there were
that's
other
all the questions. So now we're gonna get into the breakout session. So we do this every month, and we chat between 4 to 5 people. But in the meantime, be sure to leave y'all's info in below, so that we have it, and be sure to connect with us offline. So Yonah, appreciate the presentation. I think it was awesome. Yeah, very well spoken guy. And be sure to drop your meetup and your podcast into the chat so we can support it. But
Yeah.
we'll go ahead and do
Thanks so much.
breakout rooms.
Awesome. I appreciate you guys having me so much. Actually, this I'll put a link in there. Okay, guys, thanks so much, and have a good evening.
All right. See, this is working.